Hello and welcome to Investors Hangout. This fortnightly interaction to help you learn and understand investments and saving issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, over the past few weeks, equity investors have been on a roller coaster ride of sorts. While the market has fallen sharply on certain days, there have been other days when the market have risen significantly. So the question is, does that make you nervous? Does that make you wonder if, what are you doing here? What will happen to your equity investments? If so, then today's episode is for you. What to do in a shaky market? Our CEO Dhirendra Kumar joins us to tell us more about that. Welcome, Dhirendra.
Thank you.
Now, over the past few weeks, we've seen the market falling sharply on certain days, and anyone who must have wondered what volatility is must have understood in the past few weeks. So, what is really happening, and how should equity investors deal with this? Is this a reason to worry?
For new investors, it's always, it's not a matter that, is it a reason to worry or not? That is the nature of the beast. That is what equity is like. It gets, in the short run, it gets excited for no reason, and it gets disappointed for no reason. It is depressing. So it's very hard to guess, but that is how it is. And that is what creates opportunity. That is what creates, alarm. So what to do in a shaky market? Not get shaken. And how not to do it? You can only do few things. One is that there is a natural cycle to it. It takes time. If I tell any investor that don't be upset, markets will be it'll be fine over a period of time. If you have invested 2 months back, I will not be able to comfort anybody. And the more you have invested, if you have invested 10 lakh rupee at one go, and you see that it has gone down in value by 5% in a single day, then any kind of consolation will not help. So it is a matter of getting used to. Then it's a matter of getting used to and sticking to it. So stay the course. Make sure that it's a long-term money. Make sure that you don't need the money, because whatever I may say, whatever you might have the understanding, if you need the money in 8 months' time, when your child is getting into the school, assuming that you really won't be able to, you can't be a long-term investor. You might be a long-term believer, but you can't be a long-term investor because you need the money. So it should be, you're very likely you are unlikely to need the money over this time period. And depending on your experience, choose the right vehicle. If you are actually losing your sleep, no investment is worth losing your sleep. So because what do you do with the money if you are unable to just reconcile with the character of it? So I would say that choose. If you are losing your sleep, take your money out, get back into the market again in a more methodical way. The methodical way is that if you have no experience, start with something which is relatively more stable. And if you're a relatively new investor, don't invest at one go, because most investors think that they have to accumulate the money, keep it in the bank, and once it becomes something sizable, then they will invest. No, that's not the way to go. By investing over a period of time, gradually, you are able to average your investment and you are able to save yourself from the anxiety. In fact, for all those investors who will keep on investing from now, who have started investing and will continue investing, in fact, this whatever is the fall, the big decline is great news, because you are buying cheap and you are unlikely to need this money, and you are confident that based on your own experience, anybody who has invested for 5 years and 10 years knows that it has been rewarding, it has been profitable, it has been sometimes hugely rewarding, it's moderately rewarding, but definitely more rewarding than what you earn in a fixed deposit. And that is your base case. That is your that is your opportunity cost. So I would say that feel happy if you're a long-term investor. If you just drifted in the market accidentally and you were feeling happy that okay, market is a very easy way to make money without it, I think it is a wake-up call for all those people. Get to a plan, but don't sleep over it. There's a huge opportunity. I'm not talking of huge opportunity in terms of state of the market. I'm saying that investing in a market-linked investment, making an investment in a market-linked avenue is a great opportunity. Don't deprive yourself simply because the market has got shaken. So choose the right vehicle, be regular, and that is how you can actually overcome the jittery market.
All right, so no reason to be shaken, even though the market is shaky. But a lot of investors think, where should they, they contemplate where should they be investing? Large cap, mid cap, small cap? How should they go about it?
Unfortunately, yes, there is a problem of plenty. It's confusing. It is not only confusing, it has been, officially being told that, okay, there are these many funds, there are these many kind of funds. So you have to, swim in this ocean of mutual fund to find out which is the right one. But I think, there might be 30, 40 kind of fund. And beyond the 30, 40 kind, you are still finding a new supply coming in, new kind of fund, new index fund, new ETF, new this thing, new that thing. And investor gets, are faced with the added confusion. But I think, you don't need to really confuse yourself. It is in all facets of our life. You have a problem of plenty in everything. When you want to buy a detergent powder or a soap or a shampoo or this or that. But mutual fund isn't like that. It has a utility. You can do without looking at the whole complexity. Money for few days, few months, up to a year, you have a certain kind of fund. Liquid fund, ultra short-term bond fund, end of the story. You don't need to look any further. Money for the medium term. That I think, medium term meaning 3 to 5 years time frame, or 2 to 5 years time frame. Depends. If it is for a non-negotiable goal, it should be fixed income. It is for a negotiable goal, which means that it doesn't matter, if it is postponed by 6 months, 1 year, 2 years. There are goals, which can't be negotiated. If that is that, then look for an equity income fund, small allocation to equity, and non-negotiable goal, be in a fixed income, and long-term money, be into equity. Which kind of equity fund? Large cap, mid cap, small cap, index fund, ETF, this, that. Choose a flexi cap fund. It is an all-in-one thing. All-in-one thing because you don't have to really worry about it. The fund manager will take care that what part of the money should be in small caps, mid caps, and opportunistically be moving around. Ideally, choose a flexi cap fund which will be investing also in the international market, so that you get real diversification investing abroad, and there are options available. So keep it simple. This is the simplest strategy, and this is meant for somebody who has gotten used to the ups and downs. If you haven't gotten used to the ups and downs, but start with a balanced advantage fund or an aggressive hybrid fund. They still have 30-40% into fixed income. They will not collapse when the market declines, and that is something, because most investors they require acclimatizing themselves to the market. They are scared away by the market the moment you see a 5% decline in a day, and quite understandably, no amount of preaching will turn them into a believer. Because once you see that you have invested ₹1 million and it has suddenly become, in a day's time, it has become 9.5 lakh rupees, and once you go and pull it out, you'll be liable for the exit load, 1% or 2% more. Then it scares you forever, drives you out of the market, and then you are deprived of this great vehicle.
An individual should not be thinking in terms of large cap, mid cap, small cap. They
Not
should
at all.
just
They
be
should keep it simple. Balanced advantage fund if you are a new one, or if you need to invest and also save tax, a tax saving fund. So this is for the starters. And if you have gotten used to it, flexi cap fund, that will take care of things.
All right. Time now to move on to our viewers' questions, and the first one has been sent in by S. Manjunath. He wants to know if it's advisable to invest in thematic or sectoral funds based on information technology for a horizon of 5 to 7 years. How long do you think the current performance or returns will sustain?
I'm normally a proponent of keeping it simple, diversify, and that is why you invest in a mutual fund. And when you are investing in a diversified fund, you are not deprived of information technology. You have information technology as well, and quite meaningfully, because our indices have. But there are information technology has been an exception, because it has done exceedingly well over a very long period of time, and it has done exceedingly well because these companies have done very well. Though the Indian investable universe of IT services company, because India is, it's not a manufacturing hub. We only have, India has made a name for itself in the IT services sector, and So they have done exceptionally well. They have been able to maintain the growth momentum. It is still a rewarding business. It's still a growing business, a modest or a high margin business, which has been growing at 15, 18, 20%. And it is not a cyclical business, because these technology business, services business, they are configured in such a manner that they are almost like a utility business. A lot of businesses globally depend on these businesses to support their continuity. Two promising sector funds which have made a very good long-term case for themselves are pharma funds and technology fund. Now the downside is that because they are invested in only a very narrow universe of a certain kind of companies which are impacted by similar uh, similar dynamics. If there is something unfavorable which is happening to the sector, they all get affected exactly in the same manner. Whether it be TCS or Infosys or Wipro or HCL Technology, these four prominent companies actually dominate the portfolio of all the IT funds. So that is why they turn out to be more volatile. They show very big things. But mind you, we refer to volatility as a great risk. Volatility is not great risk. Volatility is volatility. It goes up. It is wild. It is a roller coaster. But that doesn't mean that it is unsafe. Lack of safety, the potential of losing money, is when you have a less thoughtful in fund manager who invests in a set of companies where the money goes down the tube, when it becomes unproductive, or it turns out to be bad investment, poor judgment. So that is the real risk. Volatility is scary for many, and new investors it is all the more scary. If you are fine with the ups and downs of these sector funds, pharma and IT, they still hold promise, because one sector where we are well on our way to remain a global leader, and in both the sectors, so to say, a global leader. India has actually become a pharmacy to the world, and here too we have become actually the technology support system for the world.
So it's good to invest in
Good
thematic.
to invest there. The time when it will not be worth investing in these companies, when they stop growing, or the competition becomes so intense that they lose on the margin. Everybody is trying to undercut each other. I don't visualize both of it happening, because they have been able to make a strategy, or exist with modest margin, with reasonable growth for last 2 decades.
Fine. Now, Debra Chaudhary has 7 to 8 goals, he says. So, should he create a separate portfolio and SIPs for each one of his goals? Wouldn't it be too much to monitor? He wants to know.
Yeah, that will be, he'll have to strike a balance between these two. But I'll give him rather the principle than the exact prescription, because knowing the principle, he can adapt it to his own requirement any way he wants to. One is that divide your goals into immediate, medium term, and long term. And even the immediate and medium term should be negotiability and non-negotiability. So what is non-negotiable up to medium term? It should be in fixed income. You don't need a very diverse portfolio. The money should be handy, and you should not be dependent on the market to spend that money as and when you need it. That is what money is meant for. If you don't have the comfort of having that money when you need it, it's no good. So that's one. So these are the principles, and the money which you are unlikely to need for 5 years and more should be invested in dominantly into equity. Then you can bunch these these goals, how much money you are likely to need for each of them, and then invest accordingly. So up to medium term, it should be in fixed income. Only the non-negotiable bit could be a small part of it into equities. And so you work on your cash flow, that you need 5 lakh rupees 3 years from now, 10 lakh rupees 5 years from now, and then maybe you need 1 crore of rupees sometime after you retire, which is 25 years from now. These are 3 goals, assuming, and in between, maybe you want to go on a holiday, which will, expensive holiday, or maybe you want to upgrade your car or something. So if these are the specific goals, then you bunch them by the time, and then 5 years and more should be in equity. If you bunch them together, and if you're diversified, that is it. You don't need to. You don't necessarily need a
separate portfolio and
a separate portfolio.
That does not
Keep
make
it
a
in your
difference.
mind. Maybe what you can do is, you can use value research online effectively for this. You could be investing 20,000 rupees in a single fund. which is very well diversified, or you can be investing in 3 funds. And you can split that money. You can mark a part of that money on value research online in my investment. You can tag a certain part of that money to different goals. You can tag a small part of your money of same investment for different goals, for easy tracking. That are you well on your way to achieving that goal as and when you need it. So you might be investing 20,000 rupees in 2 funds, and you can mark a certain part, different parts, into 5 goals, which could be spread over next 5 to 15 years.
All right. Now, Krishna Kumar Tripathi asks, what type of mutual funds are safe other than debt funds, where the parked sum of money is protected and also grows in value? Would you suggest balanced advantage fund for this purpose?
No mutual fund offers you a protection in a guaranteed way, in a written way, that okay, you will not lose your money, lose your capital, or you are assured this much of return. It is all market linked. You might get, of course, by the very design of funds where they are supposed to invest, and regulations have become, a little more prescriptive, more elaborate in terms of it is clearly specifying which funds will be invested where. And you can generally assume that what should be the likely, what can you expect from this fund? What could you expect in terms of the downside as well as the upside? So from that standpoint, yes, if you invest, and then the likelihood of achieving that return is a function of your investment time frame. I think if you invest for 7 years and more, if you would have invested for 7 years and more in the past, in any mutual fund, any equity mutual fund, you would not have lost money. But there could be exceptions to this in future. This is not there's not a guarantee, or there's not an assurance that it will not happen in future. There could be a bad phase in the bad economic phase, or something, a calamity happens. That market can go up, can come down, and you can have a 7-year holding period, where the point at which you got in and the point at which you are looking at to get out, that is the time frame when you may not have made adequate return. But generally speaking, I would say that if you're looking at 3 to 5 years time frame, an equity income fund is likely to be giving you, beating fixed income return, what you get from a corresponding bank deposit. Not only that, it will also be more tax efficient, because over 3-year time period, if you're investing in an equity fund, there will be only simple 10% tax rate on your gains. So that itself makes it very efficient, because your bank deposit, the interest earned every year, will be added to your income and taxed. So if you are paying taxes, this could be, it's reasonable to expect fixed income beating return in a 3 to 5 year time frame.
And is balanced advantage fund?
Balanced advantage fund is still assuming little greater risk. I'm referring to equity income fund, which never goes beyond 15, 20, 25% into equity.
Now, Alka Mevada wants to know if gilt funds are appropriate for retail investors as a long-term debt investment and part of asset allocation strategy.
A lot of investors have this feeling, have the sense that gilt fund issued because they invest in government securities only. They are safe, and they are safe in a sense that government will not default. The bonds in which these fund managers have invested, they will not default. And if they default, then we will have many other problems in the country than just worrying about the gilt. But that is one part of it. There is another dimension to any fixed income investment, that when interest rates go up, bonds go down in value. Bonds go down in value because the older pricing of the bond is adjusted for lower rates, and now new bonds will actually earn you higher interest. So the older, lower yielding bonds go down in value, because you have the option of buying new bonds issued by companies which will get you higher return. That is why gilts can also go down in value. If you invest in gilt today and tomorrow there is an interest rate hike, gilt funds will show a decline in value. And that is the time and because we all invest in open-end funds, investors take their money out. So if you stay invested, the fund manager is unable to lock your money in a specific yield, in a specific yielding gilt to be held till its maturity. That is the way you can actually lock into the returns by holding it till maturity. If there is a bond which is yielding 7% and tomorrow it goes down because it's getting marked down, and if you hold it till maturity, you will get 7%. But the problem is that if other investors pull out, then the fund manager will have to sell. Fund managers will have to sell and the price will go down. And that is why, uh, investing in gilt, which is perceived to be risk-free, may not be risk-free when you are investing in a gilt fund.
All right, now Arvind Kumar Agarwal has sent in the next question. He has an investment in two similar performing mutual fund schemes and wants to make a redemption for booking profit. So, which among the two would you suggest? The one with no exit load, but he'll have to pay long term capital gain tax on that? Or the other one which has no gains, but he will have to bear an exit load of 1% on that?
Okay, this is pretty straightforward. It is not. This is also not a matter of opinion. This is a matter of pure arithmetic. Let me just give you an example. You invested 100 rupee.
Yeah.
It is still short term, which means you will be liable to pay 15% tax on the gains, less than 1 year. And if it is more than 1 year, the difference, you will be taxed at 10% of the gains. So look at the difference. 10% and 15%, how much difference it will be. In the other case, you will be liable for exit load. Exit load is 1% of the total thing. So just do whichever is lower, do it. But if you can possibly avoid, if you're just changing it simply because you have to book profit, don't do it, because many people think that they have to book profit simply because something has gone up. What do you do after you book profit? Maybe wait for the big correction. But then when the big correction happens, you get scared and maybe you start thinking that it may go down further. So this anticipation, being fearful, being scared, and then getting out of the market, and if suddenly the market turns around, goes up again by 10-15%, then you have this regret that, okay, you have missed the bus. That is the problem of trying to time it. So if you are trying to time the market by doing this exercise, don't do it. If you have to somehow, if you need the money, and that's a good enough reason for you to actually take your money out, then it's pure arithmetic should guide your decision.
Now, Ashish Godbole has asked for your views on the NFOs in the newly crafted multi-cap category. Should one invest in them?
One is to understand that, why? Are you getting anything meaningful? There is a difference between, these multi-caps and the flexi-caps. Earlier, these multi-caps were flexi-caps. There was no restriction. They could invest anywhere. They were all go anywhere fund.
Yeah.
Then SEBI one day came up with a guideline which actually changed their life. They said that multi-cap funds must invest 25% into large cap, 25% into mid cap, and 25%, this is the minimum investment, 25% into small cap. So many of the funds had turned big, and they thought that if they have to necessarily compulsorily invest 25% into small cap, it will be a very difficult thing for them to manage. So they went, there was a hue and cry in the marketplace. The market actually went down because everybody thought that now fund managers will be forced to buy small cap and they'll be forced to sell large cap simply because the regulation has changed. SEBI understood that, okay, this is something which can negatively impact the market sentiment. They went about changing it. So they gave fund managers an opportunity that, okay, they allowed the creation of a flexi cap fund, which will retain the character of the erstwhile multi-cap fund. Then they said that if fund managers can actually change the character, change their objective from being a multi-cap fund to a flexi cap fund. So they carried on. Now, every fund manager is finding today that launching a new fund, they are able to attract more investors. So they are launching a new fund offer simply because there are bankers and there are distributors who are selling a new fund. And they have this window available because SEBI has said that you can't have more than one fund in a single category. So all those people who vacated this place, their chair of the multi-cap fund, they have this vacant chair which they are trying to fill, and they are trying to fill it opportunistically. They need it. Do you really need one thing? That's the first question to ask. The second question is that in some cases it might be useful, But generally, one should avoid a generic category like, multi-cap. Why invest in a new fund? Anything that you know about a fund is only after it has existed for a while.
Yes.
Here is a fund where it is only a story. The story is very well defined, that this much will be in equity, this much will be in small cap, large cap, mid cap, and so on and so forth. The real thing is that flexi cap funds managed by good fund managers face a constraint. Face a constraint that when they turn big, assuming there is a flexi cap fund, it has done well, it attracts, and this is a winner's curse. A fund does well, it gets more money. When it gets more money, it gets hard to deploy more money. And if the fund was somehow, trying to derive its performance or has delivered a great performance by investing a large number of great ideas in small companies, that is not a very replicable strategy. You have to really be on the lookout for a great company and be right with it. Not finding a great company is first challenge, and then and you have to find it ahead of others when everybody thinks that it is not a great company. And then the third thing is that you should be right. If you thought that it's a great company but it did not turn out to be a great company, it will be a disaster anyway. And once you succeed with this, then you have to see that, is it replicable? More investors start pouring money into that fund. Can you find as many opportunities, as many ideas? So large flexi cap fund, they are finding it hard to invest meaningfully into small cap and mid caps. And it is actually like a forced diversification, that this much money will definitely be in small cap and mid cap. That is the difference between a flexi cap and a multi cap. But let them build the case for themselves. Let them, prove their mettle, and then get back. You are not missing out on any great opportunity.
So avoid NFOs.
Yeah, they are avoidable.
Now, today's last question has been sent in by Varghese Joseph. He asks, is it a good time to rebalance the portfolio?
Depends. Look at if it is an old portfolio, and if you have already set an asset allocation for yourself, that it should be 50-50, 75-25 or whatever. And if it has gone completely out of whack, then change it. If it is a new portfolio and you have set an asset allocation and it is still gone out of whack, look at the cost, because the cost that you will incur is exit load, possibly, on some of your investment, and the capital gains tax. One should rebalance once the asset allocation goes completely on a different tangent. If you thought that it will be 50-50 and now because of appreciation in equity, your 50 has become 90. You must change, because otherwise you will have great regret if the market tanks, that you did not realize a part of the gain. So do that, but don't do it too much. Earlier, there was only one disadvantage.
Okay, now there are.
Now there are two, because when there was no capital gains tax, you could move your money from equity to debt. Now you have to be a little careful about that, because assuming that you invested in equity and you invested 100 rupee, and that 100 rupee becomes 150 rupee. The moment you realize 50 rupees gain by investing, by redeeming that money, you are liable to pay 10% if it is long term, 15% for the short term gains. So your 50 rupee will get reduced to 40 rupee. So your money, which was worth 150 rupee and it was growing, your 150 rupee was growing when it was invested in equity. But if you make that change from tomorrow onward, once that money is invested again, 140 rupee will start growing, because 10 rupee has gone to the government. So look at the cost. It is not a zero cost thing anymore.
Well, with that, it's a wrap on this episode. Thank you, Dhirendra.
Thank you.
Thank you to all our viewers. Do keep sending us your questions. Keep watching this space for more information. And if you like the show, do subscribe to our YouTube channel. Take care. Bye for now. Merry Christmas.